are ever looking at stocks, Morningstar, you can get their reports for free, like the premium ones.
How?
So they don't have a security wall on their PDF file. One of my friends found this on Reddit. So you can get any stock you want on Morningstar with the link.
That's insane.
I'll email it to you now. Just in case you ever wonder.
Okay, so I want to do some inside stock
Yeah.
investigation. That's wild. I interned at a wealth management firm that had like the Morningstar thing. So I got to read all those reports.
So all you have to do on the link, just copy and paste the link, and then you just have to like change the less, like 2, 3, 4 letters, whatever stock you're looking at. Just in case.
I love it. Okay, so last class, yeah, we ended with the zero lower bound. So today we'll talk about the non-conventional monetary policy tools that the Federal Reserve used to combat the global financial crisis. So the first thing they did was the discount window expansion. They lowered the discount rate from 100 to 50 basis points. I found out yesterday that's called the primary liquidity rate. That's what the Fed tends to call it in their publications and in their like interviews. That's what Powell called it. And then remember, there's also a secondary credit rate, which is set above the primary rate, the normal discount window rate, and that's for banks that are that are like financially distressed, that can't get money from other banks in like the federal funds market. Yeah, like I said, they cut in half in 2008 and then lowered it to only 25 basis points above the federal funds rate after that. During the crisis, again, it was very limited. It was used very limitedly by banks because they didn't want the stigma associated with it. It's bad in normal times. It's a bad sign that a bank can't get loans from anyone else. But in terms of a crisis, or during a crisis, it's awful. If you ever watched Too Big to Fail, the HBO special based on Andrew Ross Sorkin's book about the financial crisis, the Fed and the Treasury teamed up to try to give TARP to banks to try to bail them out. Some of the ones that were pretty healthy or thought they were healthy enough tried to refuse TARP because they didn't want to appear to the market to be in financial distress. And it's the same basic idea that they don't want outsiders or investors to see the stigma and then to think that they're unhealthy and refuse to lend them money or like demand money back from them, like calling their loans. Yeah. Next thing they did was implement the term auction facility. This was a temporary institution that they created during the crisis. Unlike the discount window that's always around, this was like brand new and just lasted for a short time. So the loans they made were through a competitive auction. So it was similar to open market operations where banks bid on the potential loans. But this was lower than the discount rate. This was a market determined rate, so it ended up being lower than that, more in line with the federal funds rate. And because it was new and you didn't have, past banks that failed after taking money like from the discount window, there was a lot less stigma involved, so banks were more willing to get involved and to borrow from the term auction facility. Originally, they planned on just having $20 billion in the term auction facility, but it ended up being $400 billion that they loaned out as the crisis continued to deepen. At first, the Fed didn't think the crisis was going to be as bad as it turned out to be. I think it was like several months into it, they were still concerned about inflation being too high. They weren't so concerned about like the downside risk and the high unemployment rate at first. So if you look at like a lot of their early responses to the crisis, it was like 20 billion isn't small, but compared to the 400 billion it ended up being, it started out pretty small just because they didn't realize just how bad it was going to be.
Didn't they have other banks get involved too that were part of the TARP program?
What do you mean?
Did they have the Fed have a meeting? It's like some of the big things, it's like their health.
Yeah, and they show that in Too Big to Fail.
Yeah.
They spend like a whole weekend like trying to. Now I don't remember off the top of my head who was failing.
It was like Lehman,
Like Lehman was failing.
Bear Stearns.
Didn't they just let Lehman fail, or was it Bear Stearns they let fail?
I think they let Lehman go.
We're going to talk about this next week, but I don't have all the details.
Then AIG,
Ready, yeah.
they just let go too.
So they had these meetings, and what came out of it a lot was trying to find buyers for these insolvent banks. So there was, I don't know, they got together JP Morgan, and they got like Citigroup, and like,
Right.
I don't remember Washington Mutual was there. They went under bad
Yeah.
because of all their mortgages. So they were basically trying to convince like investment banks to buy commercial banks and vice versa. You pair one healthy one with like a one in bad shape. And the whole time like Barclays was involved, they might buy someone. And at the last minute, the Chancellor of the Exchequer, like basically like the Treasury Secretary of England, said no, like you're not allowed to. And like put a kibosh on the deal. So they're like scrambling. It's like Hank Paulson, the Secretary of Treasury, is like scrambling at the last second to try to figure out who can buy who.
Yeah.
Because had say JP Morgan, if they don't buy, I don't know, whatever commercial bank was going under, like that bank goes bankrupt and there's a run on the banks.
Right.
Because a bank of that size like hadn't failed in the United States before. But to read the book and to watch the movie, like it seems like this crisis was in like real time and they had like 48 hours to solve it. It's like a ticking clock. Like it's kind of wild. Especially like older crises like the Great Depression happened, like the start of the Great Depression happened over like a month or two. Things just used to take so much more time because it was so long to like talk to people or to find out information.
Right.
Whereas now it was 2008, so like pull up their BlackBerry and they find out like almost immediately. BlackBerry throwback.
Windows XP.
It's a bubble. It was a bubble. That's a problem. Bubble burst and I was no more Blackberries.
Everybody had a BlackBerry.
Yeah, that was like the thing.
It wasn't professional. If you were professional, like 2010, you had a BlackBerry.
I remember my mom's boss, even before that, like back in like the 90s, early 2000s, had a Palm Pilot.
No.
Yeah.
That's amazing.
So like, I don't know, when he was like done with it or whatever, when he got his BlackBerry, he just like gave it to my mom. And she never used it. So it was just like sitting in our attic. I don't even know what you can do on a Palm Pilot. But I had like the little, what do they call the stick?
Stylus.
Yeah, the stylus.
What do they call this?
I'm sorry, I haven't used my Palm Pilot in a while.
Yeah, but like if you have your Samsung Galaxy Note, whatever they're on now, they always have a stylus.
I have a Samsung, but it's like not big enough.
Well, do you have a Galaxy?
No, I do have a Galaxy.
Yeah, a regular, not a Note. You have an S, whatever, probably an S9,
S8 active.
an S8, I have an S8.
Because I drop my phone a lot, so I had like extra protection on it.
Nice.
Active.
I got the.
Active, or clumsy idiot. The thing I hate is you put like the big box on it, you can't fit your phone in your pocket.
Yeah, I don't have a big box, my case is pretty small.
Yeah, I like that one. But I need to get a clip for my pocket. Walk around like that.
Are you gonna
The
be like
best
those
part-
old
True old
men that
man,
have
yeah.
a holster?
Yeah. I love when they get the big phones and it literally is a holster.
It is. That's what they call it. They actually call
They
it a
call it
phone
that.
holster. Like whenever they sell it to you at Verizon or AT&T, they call it a phone holster. And then they're always camo. They always have the camo case. whenever
So
they
no
have
one
the
can see it.
holster.
That's- Imagine if it was orange and you're like out in the woods, you need to hide from someone. You're
What do
screwed.
you
That's
mean
why you gotta
need
make
to
a
hide?
camo.
If it's rifle season, you need it the bright orange. I got shot during rifle season down in Fayette County whenever my mom was growing up. Yeah, and he was wearing orange too. So he never went back hunting in Fayette County.
That's a lesson you take away from it.
You just don't
It's the
go to
people
Fayette-
down there.
You just don't go to Fayette County in general.
Yeah.
Well, I've had my family has had many a bad experience in Fayette County, so.
I can't say I have any experience in Fayette County, so I'll just take your advice.
The Fayette County
Yeah.
Fair, never go. Just don't go.
Yeah, I'll avoid just about any county fair.
Fayette County is like the West Virginia of Pennsylvania.
No, West Virginia, Pennsylvania.
It is. It borders it, but it might as well be part of it.
Okay. I know the general area you're talking about. Let's at least get through like one slide. The next thing the Fed did was new lending programs. So they did a bunch of different weird things. If you look at like the Fed balance sheet at the time, they'll have like non-traditional lending or something. It like spikes in 2008 and then drops back to like nothing like by 2009. But in the short term, to try to provide liquidity, they did a bunch of new and weird compared to old monetary policy, like new programs. So they broadened liquidity provisions beyond the typical financial institutions. So they loan to a broader array of counterparties, as they say. So instead of just the primary dealers, they're lending to like all banks. They're lending to like commercial banks and investment banks. They're lending to like AIGs, like insurance companies, big companies that are involved in financial markets, which is something they'd never done before. They had loans to investment banks specifically to encourage their purchases of mortgage-backed securities because the prices of those were plummeting at the time. Oh yeah, I have it right here. To help JP Morgan buy Bear Stearns, and to help AIG, who insured mortgage-backed securities. They were in bad shape at the time. They obviously weren't going to lend when the value of their assets are plummeting, like in real time. There's a really great scene in Too Big to Fail. I wrote this down so I remember, where Tim Geithner, he was a Treasury Secretary under Obama, but at the time he was the president of the Federal Reserve Bank in New York. He's talking to the Goldman CEO, David Solomon, and while Geithner's on the phone, his secretary comes in and says, Jeff Immel's on the phone for you. Like he's on the phone about like liquidity needs or something. And Solomon goes, fuck, GE needs help too.
No way.
Because it's spread from just like financial institutions to like literally like GE's like a regular company.
Yeah.
That's how like much like liquidity froze. The text has a whole list of all like there's like 8 facilities or something if you're interested. Some of them are involved in like euro dollars. So like when like businesses or banks hold, I guess just banks, when they hold currency other than the currency of their country. So if an American financial institution holds yen, that's considered euro currency. They call it that because it normally happens in Europe, that they will hold like the US dollar, I don't know, the won. But it applies to all of them. I know, it's weird.
Speaking of David Solomon, did you know that he's a DJ?
He is?
Oh yeah.
Does he like play clubs or
Oh yeah.
like normal ones that people can get into or like just like fancy ones for just bankers?
No. Like he'll go to a club and just like bump.
That's wild.
His name's DJ Soul. SOL. He has like SoundCloud remixes. Not kidding. It's like with one of my friends this summer in Cleveland. Oh, you probably know him, Barrett?
Oh yeah.
Yeah. He was working up at KeyBank in Cleveland. And I went up with one of my other friends on the golf team and we went up to Cleveland. And we like got on the topic of like David Solomon, I don't know how. He's like, you know he's a DJ. And I'm like, what? He's like, yeah, and he's like got SoundClouds. I like looked it up, he has like 3 SoundCloud mixes.
That's wild.
I know.
All right, I'll play one before the next class. I'll try to
All right.
remember. Just as people are walking in. That's appropriate, right? Okay, so what they didn't do was what's called helicopter drops, but it was pretty close to that. Helicopter drops are the idea, I think it dates back to Milton Friedman, I don't know if anyone earlier said that, of literally just giving everyone money as a way to stimulate aggregate demand. Because that's like the main concern during a crisis is that people aren't people aren't spending because banks aren't lending, businesses aren't expanding. In fact, they're usually firing people. So that's the big concern, is a drop in demand in the overall economy. So one way to combat that is to just give everyone money. Give them more money and they'll spend it. That's the idea behind fiscal stimulus. You expand unemployment benefits, like increase them or allow more people to get them, and people have more money, so now they're spending. Helps consumer confidence, helps firms' expectations of future sales and future profits, so they'll be more willing to invest in more employees or more capital goods, so they can increase production later, and it keeps the economy stable and keeps it growing. I don't know. If we keep cutting the federal funds rate when there's no recession, by the time we come to the next one, we might have to do helicopter drops or just QE on steroids.
Why do they keep dropping?
I don't know. Everything they say, like you read like the Fed minutes and it's all good. It's all good news. And then like, and in order to keep things going, we're going to cut interest rates by 25 basis points.
I don't get it.
I don't know.
Is the president pressuring them to do that?
He was pressuring them,
Okay, that's what I thought.
but he can't like recall the Fed chair.
Well, yeah.
So it shouldn't be that big of a deal.
I mean, not that it matters if the president pressures you to do one thing or not. You're an independent institution.
Yeah. So one concern is the trade war. Like if at any time, like it could escalate and China could slap big tariffs on us, we slap big tariffs on them. Suddenly international trade plummets and our GDP falls. So there's like concern about that, but I don't know if that's worth it to preemptively be cutting rates. Like things like growth is like slowing, and all the like things like consumer sentiment, business investment, it's all like peaking and starting to drop a little bit. So I guess the idea is that we're going to see maybe a mild recession coming just because of that. I don't know, I guess because of market expectations. So head that off ahead of time a little bit. Cut rates a little bit early like Greenspan did in the 90s. And just, instead of dipping down and then easing, start a little bit early so it kind of just flattens out and then goes up again. That's the only argument I can imagine for it. Because again, it's not like they're saying like in these interviews or I guess press conferences, not interviews, that things are bad or that there's like extreme weakness. Labor market is really strong, like consumer spending is still strong.
I honestly think that's that it's like close to 100% political, just because we have an election coming up.
It could be election. Well, you would think he would want the economy to do poorly so that Trump doesn't get reelected.
Why would he want that?
Because Trump's breathing down his neck, and the Democrat. You think the Democrat would pressure him worse than Trump?
Well, no, the thing is though, like, Trump's like businesses more, and if he's planning on going back into businesses, he wants Trump to get reelected.
I'll say Powell's only been on the FOMC for like 4 years now. But once he's done being chair, he's done. Like they always resign.
Right.
So I guess, I don't know how old he is. He looks kind of old.
And he's 70.
He also got that nice big tax cut, so he probably wants that tax cut to stay.
He was nominated by Obama to the FOMC.
66.
60, okay, he's pretty young. But he's about retirement age. Once you're a Fed chair, you basically get a job at Brookings.
Yeah.
How old is Nancy Pelosi?
Oh, she's like 80
77.
No, she's like 82.
79.
Yeah.
Everyone is so old in politics.
That's nuts. I had no idea she was 79. Trump's 73.
I don't know, he was the oldest president ever elected. Him or Hillary would have been the oldest president ever. Like older than Reagan.
older than Reagan. And look at what Reagan looked like after 8 years.
Look how much Carter aged in 4 years.
And Carter's still alive.
Imagine like maybe he wouldn't be if he did 8 years.
Maybe not. Maybe it's good for his health and like habitat.
It's good for your health to not be president. Look how much Obama aged. Look how much like Bush aged.
Yeah, I know. Obama was so young.
He had like no gray hair.
I know.
And by the end, he was all
It's
gray.
White.
And then
I mean, his
Michelle-
8 years, that's a long time.
And like Michelle still looks the same though, and Michelle's
Yeah.
older than him, which is funny. Because Michelle turned 50 way before he did.
Did you see how those wildfires out west were close to the Reagan Presidential Library?
Oh yeah.
Did you see like what happened?
No.
So there were like 500 goats in like a hillside, and they literally ate all the possible vegetation that was feeding like to go towards the car,
Are you serious?
and they cut it off. So
Wow.
the fire like didn't reach the library.
Now, did they put those goats there, or were those goats?
They were
there?
just free roaming in like in the area, and they saved it.
Goes to Ronald Reagan.
Yeah.
Encouraging those goats.
Really good.
That's wild. Okay, we'll get through this slide and then get out of here. Wait. I have this labeled government-sponsored entities purchasing program. I think that was a name for QE1. So basically, during the crisis, once the Fed's, once their federal funds rate hit the zero lower bound, there's no more traditional monetary policy they can do. So they've got to go out and do different things. So they began what's called large-scale asset purchases. It's also called quantitative easing. The first time quantitative easing was done was by the Japanese when they hit the zero lower bound in like the 90s, I think. They used to call it the Japanese lost decade because like back in the 70s and 80s, they were growing like crazy. Their growth rates were far above the United States, and they thought they'd overtake us. And then they had like a financial crisis with like housing market issues like we had in like the early 90s, and they've never recovered. First time they hit like 2% inflation since like the early 90s was like a couple years ago, but it turned out that Abe was just lying about it. Straight up lying about inflation. And now with their demographics that they have a shrinking and older, they have like the oldest population in the world, and it's like starting to shrink already.
Yeah, if they don't start having babies soon, they're like
Their demographics aren't
population's
that
gonna
shape.
cut in half or something crazy.
And they don't like immigrants. Like they have such like a tight-knit culture.
Well, yeah, it's like 95% Japanese.
Yeah.
Cut in half.
Yeah, cut in half population. It's gonna go from like 260 million to 100 million or something crazy like that.
I went to a talk by I think it was Michael Spence. It was one of the Nobel laureates. There's like three. It was him, Jean Tirole, and someone else. And they were talking about like global demographics, and like even China's like population growth is expected to like peak and start to turn negative in like 50 or 60 years.
India's gonna overtake them by 2050.
Yeah, and they're projecting the world population to stop growing and to start shrinking like within like 40 or 50 years.
Is that ever like wild to think about? For, like,
That's nuts.
2050?
It'll be like the first time since like the Black Plague.
But why? Do they say why?
Because when people get rich, they stop having kids.
And so. like,
Because think of
we're just gonna,
think
no,
of kids-
that makes sense, no,
Yeah.
that makes sense, but they just think that that many people are gonna get rich.
Yeah.
In between now and then, that's gonna happen.
yeah,
I don't think that's gonna happen.
In China?
even in China,
Or
the I guess the rate of poverty destruction, the rate of leaving poverty in India is nuts right now. Like the time it took me to say that sentence and like stumble over half the words, like 100 Indian people left absolute poverty.
No way.
I mean, there's so many of them that
Still.
100's not that much, but yeah, like they're getting running water and electricity
Isn't
for
that
like the
rate
first
low?
time. They're able to like buy like clothes. I know you're not going to be there, but if you guys are coming to the colloquium on Saturday, that's what we're going to be talking about. Or that's what
I'm
I'll be
kinda
sitting
sad
there
that I'm not gonna
hungover
be
while
there.
people are talking about
I'm
it.
like sad I'm not gonna be there this year.
Wait, what is this?
It's like a reading group. We're reading some stuff by like Deirdre McCluskey and a few other economists about like long run growth.
Where is it?
I was like super excited.
It's somewhere in this building.
Upstairs, it's always
Yeah.
in the Vista.
Yeah, in the Vista. I haven't read it.
Can I still come?
I don't.
You had to register.
I don't get to register to get paid. I don't. Yeah, you can't show up. But yeah, people like the global poor are joining the global middle class, which is a lot lower than our middle class, but are leaving like absolute poverty like at an astounding speed. And just that little bit, the birth rates start declining.
So they're gonna turn negative?
In like 50 I think they said like 50 years, like globally it'll peak. And, like, I mean, Europe's like below replacement right now.
Yeah, so like
'Cause you need
2.1
slightly
is
above two,
replacement, and
yeah.
most of Europe's at like 1.4.
Yeah,
But like
They have immigrants
Africa
coming in,
and India
then-
are still at 7.
yeah.
So that's like the fertility rate.
But even
So,
theirs has been shrinking. And thanks to China's like one child policy for a while, having big families is less of a thing.
yeah, but also
little less of
there's gonna be like no females. So that
There's already no females.
Yeah,
Because
so
that was
like-
like 20, 30 years ago.
Yeah, but there's still no females because they're still incentivized. There's still like 70-30 or something crazy like that.
Yeah, it's still it's just sort of like informal custom that's like
Yeah.
stuck around.
Well, China is very custom driven.
Yeah.
So. And if
So that's, I mean, the global demographics are nuts to try to think about. Okay, but back to large scale, I don't even know how we got so far off topic. Oh yeah, because of Japan. Anyway, so the first round of quantitative easing at the time was just called the Government-Sponsored Entities Purchase Program. So they ended up purchasing a total of $1.25 trillion worth of assets. And these were from basically Fannie Mae and Freddie Mac. During the financial crisis, on the Colbert Report, he called them Tina Fey and Bernie Mac. Bernie Mac's not even alive anymore, unfortunately. But that's how I remember their names, like during the financial crisis, because of that joke. Basically, they just bought mortgage-backed securities from them. Fannie and Freddie would they would originate mortgages for people, or they would like buy them from banks, like mortgage-backed securities from banks. When we talk about the financial crisis, like in depth, I'll talk about like all about how Congress was incentivizing them to lend to not insulting people. What do they call that when you're not subprime? They encouraged subprime lending in the lead up to the crisis. The purpose of quantitative easing 1 was to prop up the mortgage-backed security market by buying these bad assets from banks, so they had enough assets to be willing to lend. So it helped investment bank liquidity and also stimulate the housing market by making sure that lenders were confident enough in their own balance sheets to be willing to lend to people trying to buy a house. Housing was one of the things that drove the prosperity throughout the 2000s. So, especially during the crisis, there was the perception of a need to prop up the housing market to support it, so that way, to help economic recovery. The idea that the housing was strongly tied to economic performance. Whether that's true or not, given how so many people are moving to like large cities. I mean, you go to New York City, you go to Washington, D.C., you don't buy a house, you rent, even if you're like rich, because there's no room. So there's a question about how important it really is for the modern economy. But at the time, it was still seen as very important. The next is quantitative easing 2. So your text says not the Queen Elizabeth II cruise ship, which even I know is a bad joke. It was also called Operation Twist, which is the name of, obviously like the song Do the Twist. Back in the 60s, they actually tried to do Operation Twist, also buy longer term government assets in order to twist or like bend down the yield curve. They did that in the 60s because of the Bretton Woods system, and we couldn't be too expansionary with the gold standard. And details don't really matter, but they did it once in the 60s and they did it again. They called it Twist then because the Twist was like a popular song. And now, this time they did it, they called it that just because they did it before. So they had $600 billion worth of purchases of Treasury securities between 6 and 15-year maturities. And they sold short-term assets. So the balance sheet went from like all short-term assets and no long-term assets, like that, to less short-term assets and more long-term assets. And that had the effect of pushing down the yield curve. So in normal times, your yield curve, that's your interest rate, and this is your time. Normally it's like something like that. The longer you have to hold an asset, like the less liquid it is, the more difficult it is to sell, the longer you have to wait to get your money back. So the more interest you're getting. Plus it's compounded from like the expected inflation over time. The goal of Operation Twist because this right here was at basically 0%, so this can't go any lower. Because normal Fed policy is to move this up and down. What they did was just twist the end down like that, moving the yield curve like this, much more shallow. One of the reasons why we saw the yield curve invert lately was because during the crisis, instead of being up here, it's down like that. So it takes much less for it to invert and go negative. Yeah, so long-term interest rates are important for purchases of like durable goods, so things that last for a long time. Automobiles, capital goods for businesses, houses. So the goal was to stimulate those purchases during the recovery, especially for like firms buying capital goods and making those sorts of investments. It's good for productivity growth and for long-term growth, which was one of the hopes that they could kind of stimulate. Finally, so QE1 and 2 were announced. They said we're going to do $1.25 trillion worth of mortgage-backed security purchases. We're going to do $600 billion of long-term treasuries. QE3 was open-ended. So they said we're going to keep purchasing them until things get better. And because of their clear forward guidance, that's literally what they said. So we expect the stance of monetary policy to remain accommodative over the medium to long term. The idea was to get the market to think that inflation was going to pick up, increase inflation expectations, eventually you'll increase inflation. So yeah, they would not stop buying until the job was done. Basically what they did with QE3 was combine QE1 and 2. So they purchased agency mortgage-backed securities again, and they also purchased long-term treasuries. So it was $40 billion a month in mortgage-backed securities and $45 billion a month in long-term treasuries. And they also reinvested the principal payments. So as mortgage-backed securities and the treasuries expired, or I don't know, what's a finance term? Comes to term. Yeah. So once those came to term, expired, whatever, the Fed would take that money that they got from it and buy the same exact asset again. So if it was like a 6-year treasury that expires, they would turn around and buy another 6-year treasury with that money. So they're keeping the balance sheet the same size. They're not letting anything run off. And they use clear forward guidance to communicate the length of the program, reiterating at literally every meeting that we're keeping it going for the long term until things get better. There was the so-called taper tantrum. So the Fed, instead of just ending QE3 boom, done, they were going to taper the purchases down until it got to nothing, to sort of ease into less accommodative policy. The markets freaked out and plummeted when they thought there was going to be a taper, because the Fed changed their forward guidance, but they still hadn't tapered their purchases yet, or said they were going to. And for the Finance 303, when you do the investment game, we started a couple weeks before that. So that tanked everyone's portfolio, which is kind of ironic because back in high school in 2007 or 2008, we did a stock market game for a whole class, and it started the week the stock market crashed.
No way.
So we just quit. We just didn't make another trade the entire time. So I don't play those sorts of games anymore. I don't want to crash the market again.
I'm done.
So, all right, we'll just end with the balance sheet quick because this relates to the last two slides. So, you can see here in 2009, the mortgage-backed securities, so what they bought from Fannie and Freddie, started massively increasing. And then after it starts to taper off there, during QE2, when they weren't buying them, their portion of the balance sheet shrank a little bit, and then they remained stable, and then they purchased more here in QE3. Long-term treasuries, they began purchasing some in 2009, but it really heats up with Operation Twist there in 2011. Lending here is, back here, it's the discount window. where it spikes up here and grows is all the temporary programs enacted. So like TARP and all the other ones. And you see like it jumps, it's like huge right there. It's like most of the lending as they're trying to provide liquidity like during the crisis. And then once things settle down and lending settles back to, I don't say normal, but a calm, much lower than before, you see it shrinks again. And the traditional short-term government treasuries, which was basically the entire thing, entire balance sheet, now drops and it's a smaller portion now than it was before. Actually, let me see if I have a more updated one. Yeah, so here's the balance sheet. This is broken down by type. This is just everything. But you can see like that spike there in late 2008 is the same. This is where we went and had normal monetary policy where we just kept the federal funds rate the same. And then the dip there, down just below the millions of dollars, or the $4 trillion. That's when we started tightening. And you can see the slight jump there at the end. It was from the recent like interest rate cuts. Oh, perfect, it's the end of the slideshow.